Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. The next 20 minutes, we'll talk about uh, an interesting aspect about mutual fund investing or investing in general, which maybe I didn't think of as closely a couple of days back. But in an email exchange with two of my guests, when I was trying to decipher what is it that would prove to be a very pertinent point of conversation, this came out as one. So let me get in both our guests without much ado. They need no introduction, but Swarup, Mohanty, and Feroze Azeez with me. Gentlemen, thank you so much, both of you, for being a part of the show.
Thank you for having us, Neeraj. Always such a pleasure.
Oh, yes, indeed. Well,
to be with Feroze also together on a show, always such a pleasure.
Yeah. Usually, as we were joking about before the show, usually on a show, I always feel underdressed when Feroze Azeez is there. Today is a bit of an exception to that rule, so I'm very happy.
I dressed up due to him.
Anyways, let's talk about this very subject, right? And now that we are, I mean, for equities, we are at circa 17,200, 300. A lot of people are now saying that, in bonds, don't invest for yields moving up. Now maybe invest for capital gains also happening at some point of time over the next 12 months. Maybe some of the other risk assets have hit a bit of a plateau on the way down and are now kind of coming up as well. So the investor might be spoilt for choices as things stand. So Swarup, let's start off with you. What does an investor do at a point of time when most asset classes are looking reasonably attractive relative to the risk reward?
Yes, thank you so much for having me. And, let's just reflect and take one step back and look at it from a fund management perspective, because what applies to fund managers also applies to investors. And if you look at the markets prior to COVID, and there was this talk that the market was completely polarized, there's too much of money chasing too few stocks. And from a fund manager perspective, when we come across any fund manager and they come and say that they want to buy a good business at a good price, there were great businesses, but somewhere the prices were not lucrative for them to buy. Now come post-COVID, and I think probably COVID is one of the biggest triggers that have happened to the Indian economy. And you look at the data points, prior to COVID, India was practically slowing down. That's now changed. And you look at the underlying demand starting from, say, a two-wheeler to health insurance via GST, the data points are getting stronger by the year. And no longer can we say that the base is low. Base is definitely higher. Thanks to global inflation and oil prices, the yields have moved up, and we are looking at 10-year at around 7.2. It was 7.4 a few days back. So I agree with you that when we look at it from a fund management perspective and reflect on that same statement of buying a good business at a good price, not only has the market opened up, there are good businesses, many good businesses available at good prices. So the fund manager can do two things. One, buy the old businesses that were there, old stocks that were there in the portfolio at a good price, and add some of the stocks which he or she would have missed out because of prices earlier. And you look at the 10-year, and if 1 year ago somebody would have said 10-year would be at 7+, they would have said, just give it to me, I'll take it. And nobody knows where the yields will go, but standalone 7.4, 7.2, or anything above 7 is definitely a good yield when you look at it coming from the sovereign. So I agree with you that the investor is spoiled for choice. It's a good time for them to allocate. And if their asset allocation does require a fill up, because with the falling of markets, the equity would have fallen, one can balance it out there. At the same time, also add to the long-term part of the portfolio, there are some fantastic yield to maturity funds which are available from the industry. As I say, both sides are looking good, but as per asset allocation and risk profile, maybe Feroze is the right person to talk about it. I do agree that the investor is spoiled for choice at this moment.
Feroze, great having you as well. Just trying to understand, what's your sense at the current point of time? Does it become a dilemma that investor ko kya bole? I mean, I'm sure it's subject to each investor's risk profile, etc., etc. But I'm just trying to understand, as a pure average advice, when a lot of things, a lot of asset classes are looking good, what do you do?
See, I think, Neeraj, how we look at it at Anand is to try and see what kind of asset allocation will a person follow, right? What is the return objective? If a person has 11% return objective, the asset allocation is different. If he has a 12%, so we try and create 3 to 4 portfolios between 11 and 14% return objectives. then you have a risk objective for each of these. So that's step one. Okay, this brings in a lot of solidity to what you're going to say over periods of time. That's point one. Point two, when you're looking at asset classes like equity, okay, and today, just 15 days back, the mood was gloomy, right? Today, we are saying that we are spoiled for choice. 15 days actually is very short span of time to even react to a change in the mood. Like 15 days back also, I would have said, when you're getting equities lesser than the fundamental value, which according to us currently stands at 16,800, 16,900 Nifty at 20p. Okay, 861 is our estimate on Nifty earnings for this financial year. And if you multiply into 19 or 20p, you're looking at first calibrating and calculating what is the fundamental level of Nifty. You have to look at the asset class and see whether you're getting it cheaper than your opinion of fundamentally what it should be. Anybody could have a different opinion, or at least have an opinion what is the fundamental value. If you're getting it cheaper, don't get greedy as an investor. So at 15,500, we were screaming our lungs out saying that get invested in equity if you have a gap in it. That's point two. Point three, today debt is of course a very attractive proposition, especially because the debt side has brought in a lot of passive alternatives, which bring down cost significantly, which is very important on the debt side. In equity, I will not pursue a cost strategy. In debt, I will pursue a cost-sensitive strategy. So today you have an IDFC Guild Index Fund 2027 paper, okay, a fund which just invests in Government of India paper, right, and nothing else, and holds it till 2027 and has an expected return of 6.3% post-tax, which is as good as buying a 10% fixed deposit for a highest tax bracket investor. I think 6.3% post-tax without any credit risk in INR terms, because Government of India can mint money and give it to you, right? And still you have lakhs and lakhs of crores sitting in an FD, wanting to get that 25 paisa extra because of seniority or economies of scale. So point I'm trying to get to is, you say something which is very consistent. Point one, fill your gaps. When you get an asset class cheaper than what it fundamentally should be, sure, and fill your gaps according to the chronological order of importance. So last month we would fill equity gap. This month we will fill debt gap. That's how we look at it.
Okay. So let's try and talk about each of these piecemeal, because you guys are of course masters of the game, but individual people would just want to understand these two key asset classes and then maybe one or two more slightly more differently, and then how to approach them. So Swarup, our equity funds, despite the rally that we've seen, and while people talk about from 16,200, you could argue it's been a rally from 15,300 odd, right? Give or take a few days of flattening performance, it's been a one-way rally of sorts. Do equities still provide a good risk reward, and equity funds therefore? And then if so, within that, should people take the safety of large caps, passive or active, versus maybe choosing a flexi cap or a multi cap, which gives you both? Or should people choose the riskier, perceived riskier mid caps and small? Two questions rolled into one.
Yeah, so there are two types of investors, and there are investors who believe, and there is enough talent in the industry to back that up, that active fund management is there and active fund management is alive and kicking. But post-COVID, there was this discussion on large caps underperforming the index. I believe these, the volatility in the large caps or the exit of FIs from large caps has brought back the large cap into play. And mark my words on this, there is enough talent in the industry to beat the benchmark on the large cap side, which was a question mark prior to COVID. Our house view has been very simple, and it's what we believe, that you cannot take away the impact of COVID on balance sheets, and the larger the balance sheet, the more resilient is it. So it is advantage large company. It is advantage large automated companies post COVID. Our view on mid cap was very clear last March, when we practically asked our partners to stop selling our mid cap fund. There was a lot of issue and there was a lot of backlash to us on that part. But look at it from the data perspective, and that's what makes owning mid cap a little interesting, and that's where portfolio consistency comes up, when to own mid caps and when not to own mid caps. It's a very simple thing that when the near term returns are above median, and that's something which Feroze was referring to on the other side, is that when the near term returns are dramatically above the median, one has to reflect on owning a certain asset class. And that's what had happened to mid caps last March, where if you look at 1 year trailing just on the index, people were talking about returns of north of 40%. And then if you look at 1 year later, the investor who came looking at that 40% return actually got 20% return. Last month, that investor was negative. Thanks to this rally, the investor is a little positive. Returns come in a very lumpy manner, and one could probably be a little watchful on that, unless you have a very long-term horizon. If you have a long-term horizon, then the right time to buy equity was yesterday. And then it's not about investing long-term; it's about holding long-term. Is the real meaning of long-term. So sooner or later, the valuations of mid-cap will start looking attractive, and that's not very far away is our house view. But at this moment, even if you look at our portfolios, out of the 100 rupees we manage, nearly 64 rupees is in the large caps. And let me tell you, our mid-cap track record has not been bad at all. So that's the only caution we had raised. And as we look at the markets today, we are very confident on our stock picking, and we say that as long as you are within your risk profile and your asset allocation, do not flinch in allocating to equity as such in India. India is on a structural growth path, and post-COVID, our standing on data is very unique in the world. And please, it's about not only acknowledging that data, but internalizing that data, in which the Indian markets will create wealth. And we're very happy to see, at least in the last 2 years, the Indian investors starting to own the Indian markets. Otherwise, it was not so.
Yeah, well, largely if I own, let's see, today only somebody was making a point about how they are opening a fund which lets Indian investors invest into the Indian private markets, because there the money is coming in largely from FIs, and that should not be the case. Should be interesting a pocket to watch.
No, we're doing a fund for Indian investors at this point.
Oh, you are as well. Okay, very interesting. Okay, Feroze, आपसे पूछना चाहूंगा. So, in your sense, again, the large cap versus the mid cap dilemma, and Mirae large cap funds may do better, but the track record has shown until why. And I have no issues, Feroze, if you actually differ with Swarup. It's great to have dissidence, right, as opposed to always being in camp. Do you agree that there could be a lot of large cap funds which could outperform the passive large cap ETFs, or not necessarily so?
So generally, because Swarup Saab is as mathematical as it could get, and you generally don't differ. When both of them refer to mathematics, then both come to the same conclusion. My personal belief as an Anand Rathi or as an organization is that active management, there's enough talent. And in our experience over the last 8 years, when we have chosen
only for large caps, I mean, only for large caps.
Large cap as a category.
Yes.
If you say, let me tell you, we did an analytics which clearly exhibits that large cap as a category has the least chance of generating alpha. Okay, but does not mean you're not generating alpha in large cap. A flexi cap has large cap. A multi-cap has large cap. So you can now, for example, the Anand Rathi model portfolio of 11 schemes has close to 62% large cap, but has only one large cap scheme out of the 11. Okay. So when I agree with Swarup, I'm saying fund managers can create alpha in large cap stocks for sure. Right? At least with the clear definition of the top 100 companies being large cap, which has brought in immense clarity across organization, which doesn't exist. 100 to 250, which is 16,000 crores market cap, is considered mid cap. There's immense clarity. So I personally believe in the top 100 stocks, choosing the right sector and active weights vis-a-vis the index, is there talent to create alpha? And answer is yes. As a category, large cap is the least probable to generate alpha. That's why last year we had 3 large cap funds in our model portfolio. We reduced it to 1. And we still have a 60% in large cap, but without as many large cap funds.
Okay, just very quickly, what about the mid cap end? Are you recommending mid cap funds or flexi cap funds over large cap funds, or do you believe large caps have a better chance of outperforming? now that we are already 2,000 points or 1,800 points above the lows?
So we believe that this, not just large and mid, we are reasonably gung-ho on mid cap. Why? Because like Swarup said, there are two ways to look at it. One is to see the median return, and I think the underperformance is behind us for somebody who can hold for 3-4 years. So bullish on mid cap, bullish on even small cap. Okay, and of course, looking at the rear view mirror, it becomes very difficult emotionally for an investor to invest at this point, which is close to the trough, but it will pay off. Why do we say so? Is because we analyze the differential valuation between large and small, large and mid, and we see that the differential valuation, which has historically existed, that has got compressed. So small caps also, to our mind, today have 18% implied exposure to the 11 schemes. So mid cap tick mark, small cap also tick mark. I'm just taking the question one step ahead.
Okay. Okay, Feroze, this time I'll start with you on the other piece, which is on the debt side. We heard Swarup say that there are options available for investors. Now, to your mind, based on whatever your hypothesis is about what could happen to rates and thereby what could happen to yields and so on and so forth, what's your sense about what should investors do on the fixed income fund side?
To my mind, not get too perturbed by rates. Rate hike is about repo and reverse repo rate hikes generally. But an investor makes money or loses money on 10-year GSEC, 5-year GSEC as the benchmark. So the short-term rates by the central government could go up. That should not bother you at all, because today the spread between the short-term repo rate and the 10-year GSEC is widest, one of the widest. So even if RBI increases repo rate by 0.75%, it will not impact the 10-year GSEC by more than 0.1, 0.2, even 0.3 momentary. So that's point one. Point two, debt investing is about spreads. The second variable which you have to watch out for is lending to government and AAA. What is the extra remuneration you get to lend to the AAA corporates? That spread is about compressed. So the motivation for me to lend to a corporate for 10 years doesn't exist today. So I'm moving from corporate to GSEC. If government is going to give me 30 paisa lesser as against a corporate which has so many risks, I would rather have 30 paisa lesser. If the corporate is giving me 1.5% more, then it's worth the exercise for me to evaluate the risk of the government. So that's point two. Not so bullish on the corporate paper because the spreads are not remunerative enough. The third is the term spread, which is what is the rate of a 5-year GSEC and a 10-year GSEC. So I think the remuneration for you to move from 5-year paper to 10-year paper is also not adequate, giving away your liquidity for 5 years. So the sweet spot is 5-year GSEC, to my mind. Now, because you're not adequately being compensated to move to the 10-year paper, you're not adequately compensated to move to a corporate. And repo rates, reverse repo doesn't bother us because we are one of the few countries which has seen inflation like this. There are other countries which have not seen inflation for 40 years. Today also our 10-year GSEC average for the last 10 years is 7.48. And we are lower than the 10-year GSEC's 10-year average.
Yeah, well, that's an interesting point as well. Swarup, you started off this conversation with some thoughts around the debt side as well. Can you elaborate a bit on that?
No, see, Niraj, when you construct a portfolio, and I think something very pertinent which Feroze pointed out, and they build portfolios with a target return in mind. So everybody should have that, and there should be a goal attached to everybody's portfolio. In that, when you look at a return projection, typically most of the returns come from the equity side, that is the growth asset. The debt side plays a safety part. But in times like this, when you are able to lock into the sovereign at these yields, the debt part gives you two scope. One is to give you a kicker to that return, which otherwise was not available, say, a year ago. Once you get that kicker on the debt side, you can actually lower the risk profile of your equity side, and there cannot be a bigger double advantage under present circumstances. So people who have some long assets can lock into the 227 paper which Feroze was pointing out. We are especially an equity fund house, but our SGL Nifty index is now crossed 500 crores on the retail side, which is such a good thing to see that people on the street are recognizing this opportunity and continuing to give money. So this is that space that you have, is that you can add in some money on the debt side, which the returns of your overall portfolio, hence bringing down the risk profile of the equity side. You don't need to take the risk that you normally take for the return kicker, because when you look at 9% inflation in the US, and as Feroze said, 40-year high, there is very little anybody knows as to how that country will play out, and you cannot take away the impact on US on the rest of the world. So these are uncertain times. In these, if you are getting certain certainty, I would say one should look at it as a good opportunity.
So Swarup Mohanty, before we thank you, where is Swarup Mohanty parking his money on the debt side? What kind of funds?
No, I'm
You may
taking
not
the
tell the
target
exact
maturity.
names. Sorry?
I'm taking my SGL Nifty index. I mean, I'm getting a good deal. Why not take it? I'm just doing what I exactly said, that, by taking that 1.5% extra, I'm bringing down the risk on the pressure on my equity portfolio.
Got it. Fair call. Swarup, we'll let you go. Thank you so much for being a part of the show. Really appreciate your time.
Thank you so much, Neeraj.
All right. Well, so that is the view from Swarup Mohanty. Feroze, I would urge you to tell us, where is it that you believe people should, what kind of funds, and if you can name fund houses, then great, but otherwise just the type or the category of funds is good enough. Where should people park the money and buy?
So I think they should have several categories in their portfolio. Flexi Cap is a great category. I can also tell you the schemes. I continue to believe HDFC Flexi Cap is well poised in spite of the Prashant Jain's exit lately. You can look at Canara Robeco Flexi Cap. These are the two Flexi Caps which have a possibility of a future potential return greater than the past return. Because our analysts actually track each stock in the portfolio and come with a target NAV concept. So these are the two ones which figure out. On the small cap side, a Birla small cap fund. Past performance will look ridiculously bad, but from a future potential standpoint, that's a very good fund. Vishal is the fund manager. He was the PMS fund manager who's recently been promoted to take over this portfolio from 1st April. So that's the third fund. Kotak Emerging Equities, which is a mid-cap fund, Pankaj Tibrewal. Great nose to smell businesses much before the market can. That's the fourth one. In the large cap side, we continue to recommend Franklin Blue Chip Fund. Again, a value principle, 20 PE as against Nifty's 22 PE, trading PE, which I think in 2020 we went the value way. That's why this came into our portfolio. In bull markets, value does well, in our opinion. And that's the fifth one. So I think I've named 5 funds, and always buy not a constituent of the recommendation. If you want to actually get the merit of the recommendation, you have to buy each constituent because they are complementary in nature rather than competing in nature. Sorry, long answers, Neeraj, for short
No,
questions.
much welcome. It really helps. No, but before we let you go, on the debt side as well, Feroze, you mentioned 2-3 very interesting things. So now if somebody were to build that portfolio, what buckets within the debt side should people put in, considering the fact that we may not really see interest? The fear about interest rates rising is slightly lesser than what was maybe 2 months ago.
See, I actually agree with Swarup also. So today we have 2 funds in our debt model portfolio. The net model portfolio we keep very fluid. Every month it changes depending on the yields. So we have IDFC GILT 2027 index, and we have the ABSL SDL Nifty index. Like, can you replace the ABSL SDL by which I mean state development loans, which is like you're lending to central government or to state government. Anyway, there is a certain degree of sovereignty in both cases. State development loans can give you a little extra. I don't know what the extent. Swarup indicated 1.5%. I don't know what the portfolio constituents are. So ABSL SDL, which I have gone through as a constituent, gives you a 40 paisa, 50 paisa more than lending to government. So these are the 2 funds you can form, and don't ever worry about concentrating your money into a government fund. In my case, all my debt money is in one fund, IDFC GILT 2027. Optically, I have not diversified, but I don't need to diversify when I'm giving it to central government, because there's no problem at all. It's like holding a government. So all my debt money, which is not too much, 10-15% of my portfolio currently, is in one specific fund because it's government of India.
Feroze, Azeez, you were so frank and so open. So I profusely thank you for that. And thank you so much for being a part of this show today. It was great talking to you.
Likewise, Neeraj bhai, always a pleasure to interact with.
Thank you, sir. Thank you very
Thank
much.
you,
And
sir.
viewers,
Have a wonderful evening.
thank you. And viewers, thanks for tuning into this leg of the Mutual Fund Show.